Hi, Professor Barati here. I want to talk to you today about a key component of financial ratio analysis, which is the Dupont equation. And essentially, the Dupont equation calculates the return on equity. Return on equity is simply for every dollar that investors give our company to invest in, such as including retained earnings for every dollar we've earned, plus our common stock, we have to earn a return on that, and that return is based on our net profit for the year. So if we take our net profit for the year, simply divided by the equity that we get from the balance sheet, we'll get basically a percent. So if the return on equity is 17%, that means we earned 17 cents on every dollar that is invested in the company through the equity section of the balance sheet. Now some equations might just use common stock plus retained earnings. They'll take out the preferred stock and so on. Keep in mind, dividends paid will reduce equity. So that gets into the calculation. But the DuPont equation gets us to calculate the return on equity. But more importantly, it's not just an equation. It tells us what is driving the return on equity in the corporate model. And basically, it uses three equations or three ratios, and it combines them to get one. So it takes the net income over sales, which is the net profit margin. It multiplies it by the asset turnover, which is sales divided by total assets. And then it multiplies it by the debt ratio, which is total assets over average shareholder equity. So let's talk about net income over sales. Basically, that is the net profit margin right off of the income statement. And the net profit margin basically says for every dollar we make in sales, we're going to earn a certain percent on that dollar in net income. That net income eventually ends up in shareholder equity in the form of retained earnings. So there's a relationship there. So if we had $1 million in sales and we had $100,000 net income, basically for every dollar we generate in sales, we earn a net income of 10 cents on the dollar. That's basically what that's saying. Sales over total assets is the asset turnover ratio. In this, sometimes that is called asset utilization or asset management utilization. It's an efficiency ratio. It measures how efficient we utilize our assets. We buy assets to essentially generate sales, which eventually generates net income. So it's all a relationship between balance sheet and income statement. And that's what the DuPont model tries to show, is the relationships between the income statement and the balance sheet through the flow of sales and net income and assets. So the asset turnover basically means for every dollar we have in assets, we generate X amount of sales. Obviously, we want this to be a larger number, as we want this to be a growing number as well. So if this turnover ratio is declining, it's going down over a period of time, it means that our assets are not generating as much sales. Of course, it can mean many other things, like losing customers, or we're just simply not generating enough sales. But the assets, basically how well we manage our assets, is determined by this ratio. Now keep in mind, this ratio by nature can grow easily because assets are depreciating. We depreciate it, so it's using net assets. So every year these assets will go down, assuming we don't add any new assets. So if these assets basically are old and they're fully depreciated, we potentially could have all sales in this equation. Next, we have the leverage ratio, or the debt ratio. Total assets over average shareholder equity. And this is basically tells us what percent of our assets are financed through equity. So if we have $1 million in assets and we have $2 million in shareholder equity, it means 50% of our assets have been financed through equity, and conversely it means 50% of those same assets have been financed through debt. Therefore we call it a debt ratio. If we had $600,000 in assets and $10 million in shareholder equity, our total asset to equity would be 60%, meaning that 60% of our assets are financed through shareholder equity, which also means 40% would be financed by debt. So, simply stated, the components are the profit margin times the asset turnover. So how well we generate income on each dollar of sale times how well we generate sales on each dollar of assets times our debt ratio. That gives us return on equity. Notice the algebra here is very simple. We simply cross out sales in the numerator and denominator, cross out. That gives us net income over total assets. Net income over total assets is the return on investment ratio. So you might see problems that just start out with return on investment. Return on investment is the first two ratios of the Dupont ROE model or method. So net income over sales times sales over total assets equals return on income. How much income is generated by a dollar of assets? Continuing, notice that the total assets in the numerator and denominator will also cross out. So if we cross out the two sales and the two assets, we're left with an equation that shows net income over shareholder equity, which is essentially ROE by itself. The important thing here, though, is to see what's driving the return on equity. And the best way to do that, and you can read through these descriptions, essentially they will basically repudiate what I just said. But let's go to this company. This is Morningstar, which is a good website that gives you all this financial ratio analysis, which is great. Let's go to this profitability. Notice this net margin, which is the net profit margin in this company. Let's take the current last year, 2017. For every dollar of sales, Graco, this company, earns 17.12 cents on a dollar of sales. So their net income ratio, net profit margin ratio is 17.12%. Notice under here the asset turnover leverage. That's 1.12. So for every dollar of asset, the company is generating $1.12 in sales. So that's a good thing. And then we have the actual financial leverage, which is an average. Okay, so what it's saying is for every dollar of equity, it's paying $1.91 towards assets. And notice the return on equity is 38.93%. So if you say, okay, what's driving this return on equity? Is this company driving equity through the net margin, which is what we like to see? You see, in 2016, the company had a bad net margin year. It had a bad year. But basically, over the trend, it's looking like it's off its high of 26.87. It certainly has rebounded from 2016, and it's trying to get back to its 18-19% level. Asset turnover is actually improving over time. It was under 1. It was generating less than $1 of sale for every asset. Now it's generating slightly over $1. Financial leverage is actually coming down. They're paying down debt and becoming less risky. So they're financing less of their assets with debt, more with equity. So you basically could say that the return on equity, even though it's down a little bit from its highs, the return on equity is being driven more by the net margin and the return on asset efficiency, which are the first two equations. This is a good review, and this is how I approach the overall DuPont model. That's what it's designed to tell the investor or the analyst. Return on invested capital is basically an equation that takes the equity plus the debt, and it divides that over the net income divided by the equity plus the debt. If you take the net margin of 17.12%, 0.1712, and you multiply it by the asset turnover, you'll get close to the return on assets of 19.17. They have 19.25 here. And it's probably because they're using an average, and I'm not using an average. Notice the financial leverage. Again, they're using an average of 1.91. If you multiply the return on investment, you'll get close to their 38.93%. Let's compare this company to another let's compare this to Microsoft, and you'll see some difference here. Same approach, Microsoft. Let's look at our net margin over the years. Notice it was declining in 15 and 16, but now it's jumping back to 23.57, but still not close to their heyday of the 09-010 period. But yet, that's a pretty good net margin. Now look at their asset turnover. Their asset turnover has actually been declining just about every year. It's something management wants to look at, or something an investor would have as a red flag. Why are they not generating more sales on each dollar of asset? The turnover is shrinking. But notice here the financial leverage. It's now jumped up to 3.33. So the company's taking on more debt. It's taking on more risk. So you could honestly say that the return on equity is really driven by leverage, the use of more debt. And we're going to learn how that works in the ratios, because you can enhance return on equity with debt. Because the good thing is the debt, the interest is tax deductible. So the interest is tax deductible, which means that not all of the interest, 100% of the interest, really impacts the profit number. So you can enhance your profit by using interest. Whereas if you pay dividends instead of interest on debt, you use dividends and pay more dividends to your stockholders. Dollar for dollar, the dividend reduces equity. So you can enhance your leverage by utilizing debt. But the key to that is to use the weighted average cost of capital that debt helps to calculate. What you want to do is use the proceeds of that debt to invest in projects that generate a greater return than your weighted average cost of capital. And we'll learn about that in capital budgeting, except essentially capital budgeting helps you analyze what projects will increase value essentially enhance return on equity. So in this case, return on equity has been declining, and it could be the reason why Microsoft is using debt to pump up that return on equity. That's not necessarily a bad thing, because Microsoft has a history of being able to reinvest that money they get from debt into high-yielding projects. So it's basically a good example of the return on equity, and all the three components here: net margin, asset turnover, and return on equity, financial leverage. They're all here calculated for you, and you can see what's driving the return on equity. If net margin is consistently going up, that will enhance return on equity. Financial leverage going up can enhance return on equity. Usually you'll see financial leverage go up to enhance the return on equity at the same time when net margin and asset turnover is going down. And it's essentially financial management is basically saying to shareholders, we're just not returning the same return on equity as we used to when we were a younger growing company, but now we're a more established industry leader. We can borrow more money at lower rates. So we're going to drive our equity that way. So if you're into high growth companies, you want fast growth companies like Amazon and Facebook, you'll probably see the net margin and asset turnover driving. If you're into more established companies like Microsoft, which was once a technology leader, but they've obviously slowed in growth, you're going to see more leverage. Let's try an old company like Procter & Gamble, which is PG, and let's see what they're doing as far as their return on equity. Let's get to their ratios. Procter & Gamble's been around for over 100 years. They're an established company. Look at their net margins. They had a good year in 2017, and their net margins are good. Don't get me wrong, these are good. But financial leverage looks like it's been holding steady at 2.2, 2.26, 2.11. So not a lot of increase there. Asset turnover, slightly declining, but no alarm there. Return on equity is right now high in 2017. They had a good year, and that was driven by, look at the net margin going up. Asset turnover, hardly any change. Equity, hardly change. So this drove the return on equity. The problem is, as you can see here, Procter & Gamble doesn't really have a history of generating that kind of net income margin. So that's an outlier. You kind of want to look at this area here to see what the average is on return on equity. And it's a healthy return on equity, and it's driven mostly by keeping their margins consistent. So there's a kind of almost like a classic boring structure there where everything just stays the same and is consistent. So that's basically a good review of return on equity, knowing the different components. And the Morningstar gives you the net margin percent, the asset turnover. Again, this times that gives you return on investment. Okay? And then you take that number and multiply it by the leverage, and you'll get your return on equity. You won't get the exact numbers that Morningstar has because they're using averages, but you'll get close. So thanks for watching.